So, good morning, participants to this global academic conference of the European Banking Institute. It's my privilege to share the first panel on the conference on the implementation in Europe of the Basel III reform. The work on the major revisions of the Capital Requirements Regulation and the Capital Requirements Directive as proposed in 2020 by the European Commission in the second banking package. I reiterate sometimes with some emphasis that this is the second banking package, with the third now forthcoming. That process is now nearly complete. My sources say that the text of CRR3 and CRD6 will be published in the official journal yet in this half year. And as we know now, after the finalization of the political negotiations in December 2023, these legislative instruments will become applicable from the 1st of January 2025. We will not be able to discuss all the details of the revisions to CRR and CRD3. We made a selection of the topics based on the concept that one topic will be looking back at the completed law text as a result of the banking package 2016, and the remaining topics will be dealing with true new and topical issues. It's my privilege to introduce the panel members, which I will introduce in the order that they will give a brief introduction to the topic, whereupon we have a brief discussion with you in the audience with the other panel members. So feel free to raise your hand, and the team will reach out with a microphone. Use that microphone because there are some 120 people attending this conference online, and then you will be heard. We will have, therefore, brief introduction of the topic by the panel members. We will discuss. If things are clear, then we have not a discussion and then continue with the follow. But we'd like to close each topic and then proceed with the next one. First, let me introduce Volker Wieland, also the host of this conference, as we have been here. We're very grateful, Volker, for yes, this déjà vu. We have been having the privilege to attend conferences here at Goethe University already many times. Volker Wieland is an economist with a long-standing background in academic research and a senior policy advisor to the German government and European institutions. He will be talking about the sovereign bank nexus and the issue about weighting of risks embedded in sovereign debt exposures. Next will be Klaus, Lackhoff, a senior lawyer and expert in prudential regulation of banks, working at the legal function of the ECB. He will talk about the taking of Pillar 2 measures, exercise of discretionary powers, and the manner in which legal protection may be upheld. Then we will be listening to the introduction of Tobias Tröger, a lawyer and expert on banking capital, professor at Goethe University, and he introduces the topic of the turmoil caused in the spring at the occasion of the bail-in process conducted by the Swiss authorities at Credit Suisse, and will deep dive into the question as to whether or not the regulation of regulatory capital instruments, and particularly CoCo bonds, must be changed. Gonzalo, senior policy advisor at the European Banking Federation, will take us through the position of the industry as regards to widely debated capital floors for banks using internal models for the calculation of risk weights of banking book and trading book exposures. And finally, but not lastly, Peter Mülbert of the Johannes Gutenberg University, and an expert on governance and management of financial institutions. And he will talk us through the importance of the revisions to governance rules in CRD6, the adjustment to the fit and proper testing rules and hopefully also some insights on cultural differences in Europe, which will probably make these new rules work and operate in a different way sometimes. Volker, Wieland and Gonzalo Gasós have prepared slides presentation. So here's the device where you can move towards, and the others will basically speak from the speaker notes. Volker, the floor is yours.
Well, thank you very much. It's a pleasure to contribute a few thoughts. Now, there's much to celebrate. There's a lot of progress which has been achieved. I mean, this became also clear in what Christos said about comparing textbooks in 2014 and today, what they need to talk about. But nevertheless, I chose to, or asked to focus on a topic where I think there is still a gaping hole, and that's the sovereign bank nexus, which still remains largely unresolved, not completely, but some big aspects remain unresolved. And I think maybe this is useful, but I can contribute as an economist to this. I think there are some good reasons to think that this will lead to challenges ahead, and challenges, putting it mildly. So what's new? The good, the bad, and the ugly. So good among the progress which has been made, aside from the progress that has been made in terms of regulation, capital regulation, etc., it's been positive, somewhat surprising how well euro area banks seem to have come through the banking stress of 2023 following the collapse of SVB, Signature Bank, and Credit Suisse. I mean, one could have expected a much more negative impact, I mean, even one head of government, actually the German one, felt inclined to comment on a particular bank that that is safe. So normally you don't have government heads commenting on that. And if they're safe, there's no need to. But anyway, so we've gone through that surprisingly well, and there are many reasons. One could speculate why. Maybe more capital, maybe better supervision. But this is not necessarily, this does not necessarily mean we're safe. Not good, I mean, some not good things. Of course, if you compare, for example, the euro area and the US, bank profitability remains low. There are still big barriers to consolidation. This came out also in initial remarks. You know, when do we speak about European banks? There is still a preference to deal with problems nationally. When banks get into trouble, there is no European deposit insurance. Bad, in my view, a big hole is that bank exposures to their own sovereigns and sovereigns in general remain high, but in particular the ones to their own sovereigns, home country, seed country sovereign. Regulatory privileges of those sovereign exposures have not been removed. And ugly, that's more the economic perspective. We now have an increase in interest rates. We have an increase in debt thanks to Corona. We have some highly indebted sovereigns. And if you look forward, you know, they were able to borrow a lot at low interest rates, but that debt will mature. And if you look a few years forward, the interest expenditure as a share of GDP will rise a lot. So at the same time, now we're looking forward to weakened fiscal rules with a lot more discretion, while the ECB has felt the need to actually provide more stopgap measures if called upon to kind of control the premium sovereign pay. So that's a potent cocktail for the future. That's my main point. I have some other charts. I'm going to jump through them quickly. They back up some of these arguments about the story, the narrative, the concern you have heard now. The sovereign bank nexus was a settled objective of banking union. Some things have been accomplished, such as a backstop to the SRM, the SSM, and some cases where banks were resolved or dealt with on that level. But still, you know, there are feedback effects from when sovereigns get into difficulty or are faced with concerns about their fiscal sustainability. That has feedback on the banks if they have a large exposure to sovereign debt of their home state or any particular sovereign, and it's usually the home state. And at the same time, if those banks get into trouble, then because their sovereign is faced with doubts about its fiscal sustainability, that also reduces, of course, the ability of that sovereign to support these banks, or if they nevertheless decide to support their banks, that negatively feeds back on their situation, raises sovereign premium, and the sovereign risk premium has effects usually on the rates at which you can, companies can borrow in that jurisdiction. I mentioned here the top blue bar is the removal of sovereign privileges to break one of these feedback links. Deposit insurance would help break another one. You don't need to take recourse to the national state. Okay, so in an earlier position at the German Council of Economic Experts, after the Euro debt crisis, we kept writing reports where we made proposals on deepening banking union, etc. One of the members was Isabel Schnabel, who's now on the ECB board. A bit before, Claudia Buch was a member. She is now heading the efforts for European level supervision. Anyway, we called for deepening banking regulation, banking union by removing privileges to the regulatory treatment of sovereign exposures. For example, to introduce risk-adjusted large exposure limits to address the concentration on the home country, or risk-adequate capital requirements, so removing the 0% risk weight exception for sovereign exposures. There are some alternatives which have been discussed. Tobias has been part of an initiative which focuses on concentration charges. We think, or we thought at the time, that they would need to be risk adjusted. We also called for a fiscal backstop to the SRM and for incentive compatible common deposit insurance, but conditional on actually removing the privileged treatment of sovereign exposures. Both hasn't happened, as we noted. So there's been no appetite for removing sovereign privileges and no appetite for European deposit insurance. So let me jump over that. That's not surprising, or not surprisingly, as a result of that, the bank exposures to their own sovereigns have remained high. And that has happened in spite of the central banking system, the Euro system, having bought up a lot of the government debt. Right? In cases such as the Netherlands or Germany, it's close to 50% of the public debt is now held by the central bank, largely the national, but also to some extent the ECB. It's smaller in Italy, for example, because the debt is larger. But nevertheless, here you can see this comes from the Bundesbank. Unfortunately, that is not, I couldn't update that. So it goes to 2021. We now have data up to the first 2 quarters of 2023. But here, what this shows you is the creditor structure of government debt in the Euro area by sector. We also have the insurance corporations in there. Right? So, but interestingly here, the Euro system, that's the dark blue, has really bought up a lot of this, has become a big creditor of governments. And the banks, that's the cobalt blue or so, if I call this right. The banks, I hope you can see that, they've somewhat slightly reduced the exposure, but not much. Now, but if we look closely, and the Bundesbank did that, if we look at some of the large economies here, Germany, France, Italy, and Spain, Italy and Spain, you see those banks even have actually still a very large exposure to governments. It remains very large, has even somewhat increased. If you look further back, so this is just looking at the bank holdings of government debt from 2000 to 2021 in these 4 countries. And you can see very clearly on the right side, Italy and Spain, those banks, the Italian and Spanish banks, relative to the period before the crisis, have massively increased their exposure to the home sovereign. You can see that's the dark gray and the light gray. That's loans and debt securities of the home country, owned by or held by the home country banks. So that has really risen. It's pretty high. And if you look at that, this is relative to GDP, right? So it's comparable here as a percentage of national GDP. If you look at that in this chart relative to banks' own funds, so their capital, it has really risen sharply in Italy and in Spain. Italy is the cobalt blue, Spain here is the lighter blue. France and Germany and the euro area average, it has declined, but in some countries they have increased. So the average decline is not homogeneous, it's quite heterogeneous. Okay, so that means banks, at least in the highly indebted countries, we don't have all of them here, but Italy is an example, has a government debt to GDP ratio of 144% right now. In Spain, it's about 112%. The banks located there are heavily exposed to their own sovereign. And that you can see that also with other measures. This is my last picture. And I said, I think challenges are ahead. Now, inflation, I talked with one participant just coming in. Inflation, of course, helps here. I mean, inflation is a bad thing. We want to reduce it, we want to get rid of it. But if you are highly indebted, I'm also highly indebted owning my home I live in. So if you're highly indebted, it's not necessarily a bad thing. Particularly if your debt is in nominal terms and long term, then it gets devalued in real terms. And so the debt to GDP ratios for governments have come down somewhat thanks to surprise inflation. This only works with surprise inflation because interest rates then rise. This has happened because, of course, investors want to protect against inflation risk. So now interest rates are much higher. And we did a calculation, and you can see the impact of that calculation here. We looked at the actual interest expenditure of these 4 countries the Bundesbank looked at: Germany, France, Italy, and Spain. I'm just showing Italy and Spain here. So this is the actual expenditure on interest paid for government debt in % of GDP. And you can see back, in the time which Christos mentioned, in the time of the Euro debt crisis in 2011-12, for example, Italy was paying 6% of GDP for interest on government debt. Spain, about 3% of GDP. That's the peak of the blue line. We were all looking forward to a further decline of this interest expenditure as long as interest rates remained low, but now they're high. And if you look at the orange, red and green lines, these are different scenarios. The orange is the term structure from last August. So if you look at the debt forecasts, and if you look at the interest rate term structure, and if you check, what if governments have to roll over the debt? I mean, they will have to. You look at the maturity of the debt, when the different issues are rolled over, you can calculate how the interest expenditure will rise, and you will find that basically within a few years, so before we actually manage to get rid of CO2 emissions, we will, according to this, be back to levels of interest expenditure on government debt, which is similar to the eve of the Euro debt crisis. So that's what I mean. This is a potent mix. This can reflect on the banks' exposures. The banks' exposures will reflect again on those governments. And so we have a risk, or we have an increasing risk of these kind of vicious dooms, links that we experienced, which was part of the reason why we started with banking union. And there has been some, there's been some removal planned of sovereign exposures, but those of the 0% risk weight, but that only concerns debt to other, so for example, if a German bank owns debt of the Danish government or the Polish government, right, that's in different currency. And so in the future, they will have to assign some risk weight to those, but that's a very small percentage of the exposures. It does nothing to get rid of that's Article 500A. That does nothing to remove the sovereign privileges on the own sovereign, which is still a key issue going forward.
Thank you very much, Volker. First, looking at the panel members, is there anyone that would like to raise a point? And then, if that's not the case, I will be looking in the audience, and perhaps warming up the discussion a bit. The whole debate on 0% risk weight for sovereign debt basically is, of course, a highly political one. Introducing a new system, because that would end up in potentially risk rating in accordance with the credit rating of the sovereign, because that would be aligned to the systems of corporate exposures or exposures to institutions. But to warm up the discussion, will that not result into a decrease of the solidarity within the European Union? Because that ends up in pricing of sovereign debt going up. Also in Euro countries, that would I think, be the consequence of such a step. And this is perhaps a question that I had for you.
What can I just to better understand it? What kind of solidarity do you mean?
In its nature, I would say the 0% risk weight, which is, of course, a political choice made against the standards of the Basel Committee, because the Basel Committee is clear in the sense that a ratings-based risk weight also for sovereign exposures would be the better option. But if we were to introduce that, then evidently in Europe there will be a rise of differences in interest rates payable by the various sovereigns. And that is potentially ending up the solidarity by making that fundamental political choice of putting a 0% risk weight of sovereign debt in the CRR.
Yeah, I don't quite see it that way. I think, as you said, 0% is an exception. We actually already have risk weights. We just need to remove the exception so that they apply. And that would actually force banks to take into account that there are also risks. And we have observed in the past, Christos mentioned that in his introduction, we have observed in the past that there are risks to sovereigns. I mean, and even now in the most recent crisis, even if sovereigns don't default, but we saw with Silicon Valley Bank, I mean, government debt is normally held to maturity. You get the normal amount, but you know it's mark to market, and then you have to post some losses. Right? So there are all kinds of risks associated. Now, why would we allow banks not to guard against those risks? Well, the incentive is clear, you mentioned it. Well, costs for government, so when they think about their own cost, you know, when they think about corporations, they say, well, banks have to guard against that risk, and then, yes, it will be more expensive for those corporates to borrow. But obviously, apparently, they don't want that applied to themselves. You know, it's like if I had the choice, I also wouldn't want it applied to me. Now, what that has to do with solidarity, I think it would be actually more solidarity if governments would have similar rules. Of course, they're not as risky as corporations, but if they would apply these risk weights to themselves, it would also increase the solidarity in the system, because then what would happen? German banks would have to invest more in debt from other countries. Italian banks would invest more in debt of other countries and thereby diversify. Right? So first of all, you have more cross-border lending, right? So that basically helps improve the system as a European system, makes it, you know, as a market version of solidarity. That's the kind of risk sharing which is a safer risk sharing. So you get these beneficial effects. Of course, you don't want to do it in the middle of a crisis. You want to phase it over time so banks can adjust. But I think with regard to solidarity, that's a very solidarity-oriented way of going, because you give up something, namely to the low cost of your own financing, to improve the stability of the system we're all part of. And it, by the way, I think you need to do that if you really want European deposit insurance. Otherwise, you don't get both. You won't get either of them. And European deposit insurance will also basically a market-based way of making sure those banks themselves pay in and then can be supported on a European level. I mean, the creditors can be supported on a European level.
Claudia, could you bring the microphone to Karl Philip Wojcik here on the second floor?
also very much. Does it work? No, it's better. Good morning, everyone, and thank you very much for this very interesting presentation. I have a question. We've seen over the last month, basically, in the rising interest rate environment, that there is a trend that sovereigns now also lend to retail investors, basically, directly. I think in Belgium, for instance, it was largely oversubscribed, a recent emission. How do you fit this all into the debate and into this equation? I would be interested to hear. Thank you.
Sovereigns also, or can you tell me the exact example you meant, just to better understand it? Belgium, what?
Belgium basically targeted normal savers, and savers were basically shifting from deposits in banks into higher yielding public debt. Okay. And we've seen this in Belgium, but I think also in other countries, that this is quite a successful strategy at the moment. Of course, it's small yet, but how does it fit more generally into this landscape?
I think generally, if others than banks, I looked at the creditor structure. So this is a question about who invests in government debt, and of course, with rising interest rates, it becomes more attractive again. Right? So a lot of savers kept their money in the bank for a long time. Of course, it gets devalued by inflation, but since there are no interest rates to earn, no safe interest rates to earn, it doesn't matter. And so now, of course, we live in a time where both banks have to pay more interest again on accounts, but also other interest-bearing options become much more attractive. Governments can also make efforts to somehow make that more attractive. So I think that happens across the board, but governments can also make that more attractive to somehow tap into other investors. I think generally, of course, the population or households can bear a little bit more of those. It reduces the involvement of the banks, so that makes the system a bit more stable. And if it would actually, so if the main objective here would be to get the domestic banks out of being in a large creditor position to governments, which is actually good because in crisis times, we observe that banks usually are more willing to expand their holdings. Right? Crisis times, when premia go up, you can earn money, but it's risky. And that's probably a time households move out of land, and certainly foreign creditors. If you think about the debt crisis, it was foreign creditors who moved out and sell the government debt. So I think in crisis times, it's not bad if banks increase their exposure, but then it's good if they come from a low exposure. Right? But in good times, and this is one, it's one of the high interest rates, right, because of the inflation. So people, more investors come into government debt. I think that's positive. Makes it a bit more stable.
Just a quick follow-up on something that you said. Of course, I think I fundamentally agree with what you said, but I like to say that transitions are not for academics. And you just mentioned transition, and one sentence is, yeah, of course, we don't want to phase it in at the moment when we are in crisis. But I want to just ask you, so how do you want to do that, given that you've shown us the data on the sovereign debt outstanding and the trajectory on which interest rates are on? So even if you only grandfather the whole regulation in, and it only applies to newly issued debt, how can these sovereigns actually roll over their debt? Because they're already paying these higher interest rates, and with the introduction or with the removal of the exception for risk weights also for sovereign debt, you're of course decreasing demand in the banking sector, meaning that it becomes even harder to roll over. And therefore, how do you want to prevent the sovereign debt crisis in the transition phase?
Well, if you basically announce it and then you go through it over time. So for example, if it had been announced, we proposed this in 2015, we're not the only ones, right? So if they had announced in 2015, we take 10 years to slowly introduce these risk weights, we would be there now, right? So, and you know, we had many years. I mean, if you think after the Euro debt crisis until 2019, we had 6 years of good growth. In Germany actually grew throughout the crisis itself, but basically since 2013, the economy has been on a recovery till 2019, till early 2020, the Corona crisis. So that basically is lost. This would have been a very good time. But again, if we start now, we would take 10 years and that would slowly get us there. Just, it's the same as the, you know, we did with the banking regulation. It's no different. If anything, it should be easier, because when we ask the banks to increase their risk-weight capital, this is against much more risky, in general, much more risky exposures, namely all kinds of corporations and all kinds of models which are used to reduce in calculation these exposures. In a sense, assessing the sovereign exposure is much easier and is also on balance smaller, right? Because the sovereigns can always draw on taxpayers and increase taxes. Right? But that experience is lost, right? Now, but there is a risk and there's a cost to the risk. So if we say, okay, we don't want governments to pay the risk now, right? To basically force banks to slowly move out of that large exposure and therefore accept a somewhat higher, you know, surcharge on government debt interest rates. If they don't do that, what does it mean? Well, somebody else will have to bear that cost. In the current, and this is more likely. This is what will happen, right? So we have a system where the ECB has to step in and where the ASM has to step in. Some countries say they don't want to have the ASM. So we have the risk of another sovereign crisis, you know, 5, 6, 7 years down the road. We're basically open eyes walking into. No. Is that a wise strategy? Probably not. Is it the most likely case? Yes. At least that we have the risk. Nobody can predict the crisis. Who's going to bear the problem? The cost, the ECB, and we'll see how that goes. Right? So I think they should really argue at a minimum that governments have to reduce their own exposures. So if we don't fix the banking system in that regard, they can push for governments to reduce their debt, to grow out of the debt. That would also help. That's essential anyway. So we'll see how that goes the next few years. But it would be easier if the bank's exposures would be reduced alongside.
The gentleman in the back, and then Gonzalo, and then I propose that we switch to the next speaker. Yeah.
Sorry, no, I understood it's a panel on the implementation on Basel. I mean, it's Basel III. But in Basel, there's always been a rule, which is a national discretion. I think it's never been changed. And if a debt is issued, I mean, a sovereign debt by the government or central bank in the domestic currency of the issuer, it can have zero risk weight. And that makes perfect sense from an economic and prudential point of view, because if it's the domestic currency of the issuer, there is no credit risk. It's another matter whether you get into interest risk in the banking book, like in Silicon Valley Bank, but that's not about credit risk, is another issue. The issue has always been, unfortunately, with the euro area, that either you say that the euro is not the domestic currency of France, Italy, Germany, so they don't have a domestic currency anymore, or you are basically disapplying what is in the Basel standard. And in fact, this issue of sovereign debt issued in a domestic currency, not like Argentina issuing in dollars, has always been a problem only for the euro area and then for Puerto Rico within the United States of America. So the reality is that the prudential rule, unfortunately, from an economic point of view, is correct. But that doesn't match anymore with the euro area as a monetary union, where the domestic currency of the issuer at some point, I mean, either you say there is no domestic currency, or you are not applying Basel anymore.
Perhaps collecting the last question.
Yes, thank you. I wanted to pick up on the comment about the risk weighting in the prudential framework, and a little bit related to your question as well. The key question here is that the possibility of a country exiting the euro is an event-driven risk. Perhaps the risk weight is not the right tool to address that type of risk. So you can risk weight that at 20%, 50%, whatever you want. You will always be wrong, because if the event happens, then it will be too little. And if it doesn't happen, you can argue that there is a commitment to continue in the euro, and therefore the zero risk weight could be kept. So maybe in the prudential framework, we have a stress test to consider event-driven situations. That will be a possibility 10 years ago when we were discussing the possibility of a country leaving the euro, but then you need to take into account not only the effect on that country, but the effect on the whole economy and the side effects in other countries as well. So I would argue that as probably the right way to address that risk that exists, and of course the thermometer is the spread of the bond, but it is just an indication that doesn't translate necessarily into a risk weight in the prudential framework.
Briefly?
Maybe in the last question, I think it's not about whether the event happens or not. It's about, as you said, that spreads rise. And that has effects on the economy by the banking system and gets amplified. So the event never has to happen. In that sense, I think you're safer when these banks, for example, when these Italian banks or German banks are also exposed to the sovereign, just the sovereign has a lower rating, if they have to hold more of their own capital against that risk of rising spreads, right? And then you're in a safer system. I appreciate the other question because I think it helps to clarify some things. It's wrong to think this is only a problem of the euro area. The euro area has a special problem, but of course it's a problem of Argentina. Why? Because, you know, why you're saying, well, Argentina is issuing dollar debt and nobody wants that. It's very risky because they cannot earn the dollars. Yes, but why don't they just issue national debt, right? There would be much, then they could say zero risk weight. But of course, the reason we have the problem is because also when governments issue debt in their own currency, it's not safe in real terms because, of course, they can inflate away the value of the debt. So the reason, so let me just say, so now let me just, we cannot communicate if I cannot finish my sentence, and then you can. So I think the point that, for example, a country like Argentina cannot even issue debt in its own currency. Nobody's willing to invest in Argentine peso debt. Gives you a good example that this is a basic economic problem. Of course, also nominal debt in the own currency is not safe in real terms. And so that actually, if a country inflates, means that given past experience, nobody wants to lend to them in their own currency. So then they move to foreign currency, and there you have
no, but sorry, but it's a different thing. So for Argentina, it's a market choice, right? There are no creditors to Argentina. Here wasn't a market choice. I mean, it was a political choice to move to another currency. So all the countries were left without a domestic currency. No, so I think Germany could still finance itself in Deutschmark in the markets, because the markets would look at the credit. It's not like Argentina. And then the fundamental issue that debt is in nominal terms. There is not an obligation, unless they are an inflation index, is in nominal terms. So at the end of the day, is a risk that the creditor is taking if there is inflation. So this issue of domestic currency, foreign currency, is fundamental from an economic point of view, but doesn't have anything to do with the prudential rules, which are for credit risk correct. Interest rate risk is another issue. For credit risk are correct, but they come directly from Basel. So if you talk about implementing Basel, you leave a zero risk weight on domestic exposure.
As I said, the Basel has risk weights on sovereigns. It's not an issue. No, I think it has risk weights. We have an exception. We can decide whether we want to call the exception or not. And in a monetary union, of course, you have maybe more reasons to actually use those exceptions because you don't want to create conflict between members. But even if you're not a multi-union, even if you are a country issuing debt in your own currency, there are reasons to apply these risk weights.
Okay. I propose that the two of you continue the discussion at lunch, which we try to have at the scheduled time. So thank you very much for the very interesting points and the discussion introduction of this topic. Now we switch to a truly legal topic, I would say, the application of Pillar 2 measures by competent authorities, the discretionary power, and the potential legal challenges of that. Klaus, the floor is yours.
Thank you, Bart. Thank you, Bart, for having me here. And ladies and gentlemen, I promise you we changed the height of flight. Now, we had the bird's eye view, and speaking about Pillar 2 measures, which I will do, and their limits may be perceived as lacking perspective in comparison to the other forward, and particularly the topic we had before. However, I hope I can convince you that it still has some connection to this. And before trying to do this, let me do some housekeeping. All views expressed here are obviously only myself and do not reflect the views of the institution I'm working for. Our society is undergoing fundamental structural transformations. Climate change and the decarbonization of our economies, the emergence of a new geopolitical order, and generative artificial intelligence in combination with its application to robotics are some buzzwords. The same applies to the financial sector. The growth of non-financial intermediation, digitalization and new technologies, climate change and its consequences for our economies are structural transformations which are the source of new risks and risk drivers for traditional banking risks. These risks include cyber risks, climate and nature-related risks, as well as risks from the transformation to a climate-neutral economy. These risks have an impact on traditional banking risks, like credit risk. These risks are some of the most urgent challenges for banks, but supervisory authorities have to deal with them as well. Supervisors must evaluate the actions taken by banks to address those risks and challenge banks that are not addressing them adequately and in a timely fashion. By doing this, supervisory authorities comply with their fundamental task to promote financial stability. The instruments that allow supervisors to address those risks are so-called Pillar 2 measures. By construction, Pillar 2 measures address risks which are not covered or not sufficiently covered by Pillar 1. To address these risks, Pillar 2 measures may include own funds, leverage, liquidity and governance-related quantitative and qualitative measures. Pillar 2 measures may take the form of moral suasion, recommendations, binding supervisory decisions, and related enforcement measures. I will discuss the measures and underlying powers in more detail later. Let us first look more generally at how Pillar 2 powers or measures should be used. The banking turmoil in March 23, already mentioned today, and will be discussed much more in detail later on. The banking turmoil shed some additional light on the general supervisory approach that should be followed when adopting Pillar 2 supervisory decisions. The conclusions drawn by supervisory authorities from the collapse of Silicon Valley Bank and the takeover of Credit Suisse, to mention only two banks here, are clear. We need timely and effective supervisory actions. And the ability and willingness to make use of existing Pillar 2 powers is critical in that effort. The Federal Reserve concluded that Silicon Valley Bank failed, and I quote, because of a textbook case of mismanagement by the bank. But it also acknowledged that when supervisors did identify vulnerabilities, they did not take sufficient steps to ensure that Silicon Valley Bank fixed those problems quickly enough. The IMF considered that one reason for ineffective supervisory action was the, quote, view that supervisory action can only take place where there is egregious evidence collected. And the Basel Committee recommends to supervisors to review their supervisory toolkit to ensure they are sufficient to drive concrete action at banks. Finally, the ECB submitted that the 2023 banking turmoil, I quote now, stressed the importance of a timely and effective supervisory response, and if needed, escalation whenever banks' practices appear inadequate and remediation slow. And it is stated that it will progressively apply, that the ECB will progressively apply the appropriate escalation mechanisms and tools to ensure that banks promptly and successfully address the shortcomings. So there's a broad consensus of what supervisors need to do and how to approach this. And that brings us to the question, which Pillar 2 powers are available to supervisory authorities and in particular the ECB. The legal basis for imposing Pillar 2 requirements could be Articles 102 to 6 of the CRD. These provisions need to be transposed, implemented into national law, and the ECB as supervisor of significant credit institutions in 21 member states, not 21, member states would need to apply these in the SSM member states, would need to apply national implementing provisions, which may slightly diverge from member state to member state. And I think Professor Mülbert will have to say something about that in more detail. Therefore, it was an important step of unification that the EU legislator included in Article 16 of the SSM regulation Pillar 2 powers. And in fact, this is a provision regularly used by the ECB. For example, just an example, the SREP decisions of significant credit institutions are based on it. The first paragraph of Article 16 SSM regulation sets out the conditions that must be met in order to adopt a Pillar 2 decision. It must exist either a breach or likely breach of a prudential provision, or an uncovered or unmanaged risk. The second paragraph of Article 16 includes the supervisory powers directly available to the ECB. This paragraph copied and pasted basically the powers spelled out in the CRD Article 104. Let us now have a closer look at the Pillar 2 powers enshrined in Article 16. Imposing additional own funds requirement is a fundamental supervisory tool. But imposing additional own funds requirements is by no means the only Pillar 2 power available to the ECB. In fact, Article 16 SSM regulation lists a broad range of supervisory powers, to be precise 12. Some of them may be in specific situations be better suited to drive banks to action than additional own funds requirements. This may, in particular, be the case if they are combined with enforcement actions in an escalation process. Let me give you two samples for the powers. The ECB has the power to require the reinforcement of arrangements, processes, mechanisms, and strategies of banks. This is a governance, obviously a governance-related power. Another example is that the ECB has the power to require institutions to apply specific provisioning policy or treatment of assets in terms of own funds requirements. Imposing Pillar 2 requirements on banks may be burdensome. Banks may not agree with the findings on which such a requirement is based. They may not agree that the breach of a prudential provision exists or that the risk is not sufficiently covered. In this situation, the legal framework provides specific rights to ensure an effective judicial protection and review. First, before a requirement is imposed in a supervisory decision, the bank must be heard. Second, a bank can challenge a decision before the administrative board of review. And third, it can contest the decision in front of the European Court. Does this happen? Yes, sometimes. For example, a deduction requirement that was imposed in connection with irrevocable payment commitments to deposit guarantee schemes and or resolution funds was contested, and the banks were successful. The court found that the ECB did not carry out an individual assessment taking into account the individual risk profile and the possible mitigating factors when assessing the risk resulting from these irrevocable payment commitments. Considering the judgment, the ECB adjusted the reasoning for the requirement before including it again in SREP decisions. Currently, the judgments in the new court cases are pending. However, a recent judgment on a technical issue related to leverage may be here of relevance, and I would like to bring it to your attention. In this case, a bank contested a partial rejection of a permission, which it asked for, to exclude certain exposures from the calculation of the leverage ratio. The court held that in cases where supervisors have a technical discretion, and I would just focus on this point of the decision, have a technical discretion, a manifest error exists only if one of the following can be demonstrated. First, the evidence relied on is not factually accurate, reliable or not consisting, the evidence relied on by the ECB in this case. Or second, the evidence does not contain all the relevant information which must be considered in order to assess a complex situation, or is not capable of substantiating the conclusion drawn from it. But it is not for your judiciary to make a second guess of the exercise of this discretion, if these boundaries are met. Let me conclude. And perhaps we go now, if I see it here. Let me conclude. Pillar 2 requirements are a decisive instrument to carry out effective supervision and to address also new risks. The legal framework provides supervisors with a broad range of Pillar 2 powers. The ECB made it clear that it is willing to use those powers to drive banks to swift action where needed, be it by capital add-ons or qualitative measures. And the judicial review is strict with regard to the borders of the discretion. But it is not for the union courts to replace the exercise of a given discretion by their own. So no second guessing of the exercise of discretion by the courts. Thank you very much for your attention.
Thank you very much for this important introduction, also on the development in case law. In this respect, particularly the banks of the larger countries that tend to pick up the glove and litigate against the ECB, but at the end of the day, the end result is case law from the ECB with importance for all the member states, so therefore it's very important to look at. I'm looking in the room basically, and here also at the panelists, but perhaps again to warm up a little bit the discussion. If it concerns SREP decisions, and then SREP decisions particularly with respect to capital, or the Pillar 2 required capital, the Pillar 2 guidance capital, the examples that you gave of the case law developers, not about, I think, these decisions. As far as I know, there's only one case litigated in Europe, and that was for the SREP decision of the Swedish authorities for Klarna Bank, and there the judge basically said, okay, the Swedish authorities needed to do their job again and to start revisiting basically the imposing of the capital add-on. But as far as I know, that is not the case. But have I overlooked something?
I would say yes, but it's clear that you overlooked it because the banks, all these cases about irrevocable payment commitments are this, contesting swap decisions. But, and that's why it's not so clear, because they only contest a specific requirement, only this specific requirement. So all these cases are structurally applicable to every other requirement that is in swap decision, but it is not the swap in general. And you're fully right, what has not been contested is the Pillar 2 requirement, the imposition of the capital add-on. It was only contested the specific deduction requirement in these cases. And of that, I think we have about 15 cases.
Thank you. Yes, gentleman in the third row.
Yes, hello. My name is Patrick Hess. I'm a colleague, but please still allow me my question. You started off with the transformations, the challenges, the new risks, and one of them is, as we all know, climate. And what is your personal view on, because you focused on Pillar 2 measures, but you also spoke about being contested by banks, these decisions. Your personal view, because of that legal risk for us as supervisors, should regulation, banking regulation, move in the direction of making it part of Pillar 1, and what are the chances for that to happen in your own view? Because for example, this article, famous Article 16, is what the SSM currently uses for all its climate-related measures. But of course, the discussion is there. The UK, for example, is very skeptical that this would happen to have capital charges, let's say, for not properly managing climate risk. But what's your own personal view? Thank you.
First, climate risks, we are looking at the impact. They are drivers on traditional risk. They materialize in traditional risk. So the approach is always to look at the risk. And that is also what Article 16 requires us to do. There are, as I said, 3 options under Article 16: breach, likely breach, uncovered risk. And here we would be in the, so to say, third leg, uncovered risk. And we would have, and in our decisions, I would stress we look at the risk and motivate the risk that climate elements have, or climate factors have, on traditional banking risk. And then we can base our decisions, obviously, on this risk. If this risk is not sufficiently addressed by the banks, and we address them at the moment mostly also with qualitative requirements, but it's not secluded to base also on this quantitative requirement. It's always, from this perspective, I have to say, a question of the necessary and sufficient motivation, because we must be able to defend this in court, and it must be so strong that it survives the scrutiny carried out by the court. But then all these measures are available also for climate risk and the consequences which they have for traditional banking risk.
Gentleman in the back.
Thank you. I was wondering, you mentioned as one of the possible challenges and current buzzwords artificial intelligence. And you also mentioned the requirements set out in case law for proper decision making under the manifest error of assessment test. And I wondered, is the ECB already, I know that you're already using AI in your SREP procedure. It was stated somewhere on your website, I think. And I wondered, is the ECB already thinking about how it might approach a challenge to its use of AI in this SREP process?
I think as everybody that sees the opportunities and also risk, but in particular the opportunities of generative AI, be it banks, be it supervisors, have to deal with them and have to assess their benefits they can bring for internal processes, for shaping and straightening internal processes, for freeing scarce resources, because we have to do our work with scarce resources, and so everything that can support us in this work is beneficial and we have to look at. But about this we will, as you say, announce on our website when we are doing it.
Thank you very much. Looking around in the conference room and also to my fellow panel members, I think we have had a very fruitful discussion and the important introduction that you gave. I propose that we close the discussion on your topic, Klaus, and move to the third panel member, Tobias Tröger, that will introduce the topic of potential need for changes, regulatory capital as a consequence of the lessons learned, Credit Suisse, and so forth.
Yeah, thanks, Bart. Let me start out with a confession. So when you proposed the topic to me, I was like, oh, I don't want to talk about this because I think COCOs to a certain degree are such an island solution, only really implemented in Switzerland. And also the solution that the Swiss authorities and the sovereign found for Credit Suisse troubles in 2023 were so idiosyncratic. So what can we learn from this? But then I thought, okay, Bart is a wise man. So if he proposes this topic, there must be more to it. And indeed, if you look closer, you understand that there is an overarching topic, because nowadays we already see again the ripples coming from across the Atlantic, where some real estate lenders are struggling, and that again might impose some frictions also with regard to the European banking system. And therefore, the overarching question has become, so are our banks resilient enough to weather the next storm? And if you think about it, the sources of a banking crisis may differ. So at the US regional banks in 2023, you saw poorly managed interest rate and concentration risks. You saw some backfiring regulatory arbitrage with regard to held-to-maturity securities. And of course, particularly highly fragile funding structures with uninsured deposits dominating without decent liquidity risk management in these banks. And Credit Suisse essentially was a mess, or to put it more elegantly, like the Basel Committee on Banking Supervision did, it was suffering from serious and continued weaknesses in governance, risk control, and risk management. So essentially a mess. And of course, we also saw supervisory failures or shortcomings, at least in both the United States and in Switzerland, that contributed to the crisis. And also the current real estate lenders certainly don't face exceptional risks. They seem to have managed essentially credit risk badly because they underestimated the downward adjustment in demand for office space post the COVID-19 pandemic. But the overarching question, and that's where it becomes more interesting, is the liability side of our banks' balance sheets actually sufficiently composed in a way that it allows for loss absorption, effective recapitalization when the shit hits the fan, for whatever reasons. And of course, Klaus has just told us about all the supervisory procedures that are in place in order to prevent from it hitting the fan. But it will happen, because as long as we don't have artificial general intelligence, which is just ways better than human beings, there will be error and failure. And therefore, the question is, do we have sufficient early loss absorption recapitalization capacity to avoid essentially the crisis that we saw in the spring of 2023, involving runs which are always bad and imperil an orderly crisis management. And of course, what can we learn from the crisis of 2023? So at first glance, forget about the US banks, because US banks don't issue COCOs. So they rely on preferred equity, so preferred equity, preferred shares. So it seems to be Credit Suisse only where we have to look at, but maybe not, because first of all, the preferred shares of US institutions also did not hold water, so they did not stem the tide when it hit the fan. And also, there are reasons why US banks are not issuing COCOs, and that is something that we should also look at when we discuss adjustments in the regulatory framework. And most importantly, quelling the banking turmoil of the spring 2023 included and required significant government involvement. And that can be read as a sign that at least some elements of the regulatory framework need adaptation, but it can also be understood as an indicator that there are fundamental design flaws, because we've been implementing all these reforms, and then if you take the 30,000-foot view, we're back to 2008, where governments just bail out the banks. So there is a report by the Basel Committee on Banking Supervision on the banking turmoil, which is a good read, and I highly recommend it. And it says, the Basel III framework essentially helped shield the global banking system from a more severe banking crisis. And the question is, well, really? And was it really the Basel framework, or was it not government intervention? And that is a question which I think warrants attention. And where this report really becomes interesting is where it discusses the bail-in of the COCOs at Credit Suisse. The rest is pretty old-fashioned, saying, okay, we actually really have to apply the framework, which makes sense. But it essentially raises two questions. First, why on earth did Credit Suisse actually roll over its COCO bonds in times of high crisis and even pay coupons? Because that is interesting. This is AT1 capital, so it's actually going concern loss absorption capital, but obviously the markets did not perceive it as such. And Credit Suisse was sort of serving this expectation by saying, yeah, no, this is not going to be bailed in. We're in trouble, but hey, here's a coupon payment, and of course we roll it over. And the question is, are these COCO bonds too complex for market participants to understand? That's the question that the BCBS is raising. And that is interesting in light of the structure of the Credit Suisse COCO bonds, because they were super simple, right? They were write-off bonds. So there's not even an upside that you have to calculate when pricing this instrument, because there is no conversion. There's just a write-off in case the trigger is actually hit. And can we gain anything from a regulatory reform in this regard by just telling people that the triggers are there in order to actually bail them in at some point? I don't think so, because if you think what has been in the prospectuses and all the documentation for these instruments, the triggers were pretty clear. And then, of course, the Basel Committee also raises the question, so this has been a bail-in in a going concern scenario where shareholders, equity holders, CET1 holders did not suffer. So obviously, the hybrid capital was bailed in before equity holders had to take the pummeling, and that is something that has been, termed as breaking the capital hierarchy. And is there an issue there? And the question, of course, the first that I want to raise here quickly, should we abandon COCOs altogether? Because they seem to create this highly problematic surprises for markets, et cetera, et cetera. And of course, you can argue more equity, more liquidity in banks is something that's desirable. We should do that. This proposal has been around for years, decades, but it has not been implemented. And it is quite important to understand that equity has some problems, because what COCOs are supposed to do is they should provide the capacity for supervisors to actually bail in some creditors and recapitalize the bank at an early stage when the crisis has not really materialized and the bank is not insolvent. And currently, in the current framework, they can add to that capacity, because the only thing that nowadays supervisors really can do is they can initiate the capital guidance process and say, okay, look, your capital doesn't look very good. You have to raise more capital. But what happens if investors go on strike and they don't actually subscribe to the newly issued capital? And there are good reasons why they should not do that, because the private incentives to recapitalize an ailing bank are very weak. So if there's a debt overhang, why should you assign more equity? You can gamble for resurrection. You can also somewhat rely on a government put, and that is all well known, and therefore it's not very easy for a supervisor to really compel a bank to recapitalize in the market and to actually refinance or finance a recapitalization from internal funds is also not that easy, because the only thing that supervisors can do is essentially prohibit dividend payments, coupon payments, and also bonuses. And this is something that supervisors are very hesitant to do, because it sends a very negative signal to the market and leads to a self-fulfilling prophecy. So COCOs can actually do something, because they can potentially provide the much needed tool to recapitalize a bank as a going concern. And you know, if you look at Credit Suisse, that actually seems to have worked to a certain degree. I mean, there are some qualifications to that, but you know, messy, but okay. But of course, we need to think about the design of COCOs that can actually do the trick. And there is a wonderful paper by our colleague and my friend Enrico Perotti that thinks deeply about this. And one thing that I think as a prior we need to understand is, in the European Union, COCOs have never worked. The reason for that is because the trigger for the typical EU COCO in line with regulatory prescriptions is if the book value falls to 5%. And that is a moment when the bank is de facto insolvent. And particularly problematic is this trigger, which is linked to book equity, because that requires the realization of losses. And talking about an accounting adjustment, I mean, what a signal is that, right? So this is essentially the route to Armageddon entering here, because that is nothing that really works. And therefore, it's not a surprise that none of the EU COCOs ever triggered. They all were just bailed in like any regulatory bond, regular bond in resolution. So essentially, European COCOs are not a going concern loss absorption instrument. They're just should not be labeled AT1. So a resolution remote trigger is essential. It should not require a formal restatement of book equity. So it has to come essentially at a much earlier stage. For example, at the moment when there is the need for fiscal support and there is a sovereign exposure to the risk of that bank, because then that's exactly the moment, and therefore you need a regulatory discretionary trigger that is somewhat tied, for example, to stress testing exercises and outcomes there. And then second, of course, this has to be legally certain, because one of the regulatory failures identified by the BCBS in Switzerland is that essentially the Swiss authorities were hesitant to bail in the COCOs of Credit Suisse, despite the fact that they knew this is a mess, because they thought, oh, well, maybe the trigger, the discretionary trigger that was enshrined in the bond indentures and that was included in each and every bond issuance of COCOs at Credit Suisse was not entirely clear whether that was really allowed them to activate that. And therefore, you needed this legislative intervention which said, yes, you can do it now. And of course, such a design of COCOs also takes away the concerns that you break the capital structure. Because what happens is it's a private contract that you write, which says this is a essentially a bond, but you can lose your claim against the issuer at a stage which is arbitrarily determined. And if you're willing to invest in that bond, you buy that bond, you consent to that. There's no problem there. And you know, the regulatory framework currently says in liquidation, you cannot essentially bail in any hybrid capital instrument before you actually also write down equity. And that's not what's happening here. So I think this statement, I mean, of course, it's strategic in litigation, but clearly I don't see any reason why you could speak about a breaking of the capital structure. But let me finish here with a thought on the European scenario, because that sounds like I'm super apologetic about introducing COCOs into the European framework. And I am saying no. Because our avenue, for good reasons, has been different. We actually put all our bets on resolution. And the only thing that you learn from the experience in Credit Suisse, I think, is that you have to be able, as a resolution authority, or whatever you want to call it, to trigger the recapitalization effort early, not at the stage of insolvency. And what is proposed in the literature by Enrico Perotti and others essentially is, well, let's introduce a regulatory trigger for COCOs, which gives regulatory authorities discretion to recapitalize. Hey, but that is exactly what the resolution authorities are doing, currently only at a very, very late stage. And the thing that I think Europe should do is actually think about redefining the triggering event for resolution and then trigger the recapitalization. And it doesn't really matter if you have something that is called a COCO bond or an MREL instrument. It doesn't really matter for the recapitalization purposes. And therefore, I think we can keep much more of the framework and still heed to the lessons that we learn from Credit Suisse. There's more to say, but I stop here. Thanks for your attention.
Thank you for that introduction, and thank you for giving the topic some further thought, as was within my expectations that you would do. So on that note, to warm up a little bit the discussion, shouldn't we, that's basically a question that you also raised in your introduction, completely remove the rules on COCO bonds out of the system. Credit Suisse is an example, but we have had, of course, our worries in the Deutsche Bank COCO stuff. We had fairly recently all sorts of troubles for Santander, Banco de Santander, that had big debates with the investors about Santander just executing the law, and nothing doing extraordinary or extra contractual, but at the end of the day, just get rid of the COCOs. They're causing all sorts of troubles in practice, also going concern or gone concern, but at the end of the day, and then replace start recognizing preference shares as regulatory capital, which is currently not the case. Makes things a little bit easier and clearer.
So let me briefly respond. So I think the big picture question is how can we actually induce market participants to price the risk of being bailed in with whatever instrument correctly? And that is essentially manage expectations. And that is not trivial because it is important to generate market discipline in a way that we want. So realistic expectations. And of course, it seems like COCOs, particularly, I mean, if you look at the pricing of European COCOs, that the markets essentially, rightfully, price in a zero bail-in risk. So there's no bail-in risk, which is, to a certain degree, correct until, of course, we enter resolution. So they don't differ in any way from any other bond that gets bailed in resolution in their pricing. And that is, I think, something that is wrong. And therefore, expectations seem to be even, despite the fact that everybody sort of knows that this is AT1 capital, but not really. And therefore, I think making the system a little bit more simple and relying on simple instruments like preferred shares is probably a good idea. And I want to add to this one additional thought that I haven't elaborated on, but that is sort of on my thinking. US banks don't issue COCO bonds. That means that US asset managers and institutional investors are not very familiar with that instrument. And therefore, the market is relatively small. And that means that, selling cocoa bonds to the typical investors who could hold that stuff is somewhat tricky. And if you talk to CFOs at large institutions, insurance companies, for example, they also say, you know, cocoa bonds, it's sort of highly problematic. I mean, what that signifies is that what they dislike for various reasons is a convertible cocoa bond. The write-off bonds are somewhat okay, but the convertible cocoa is problematic because the pricing is so complicated. It's not only that you have to understand when that thing is triggered, but also what the upside, the potential upside that is there due to the conversion, and you will hold equity after that with potentially unlimited upside. So what's the upside potential there? So, you know, the BCBS report at one line, I love it, says cocos are just too complex. And having written a paper, you know, years ago saying too complex to work, that is of course wonderful for me. And I think echoing your suggestion, simplifying things here is probably not such a bad idea.
So yeah, the gentleman with a white shirt.
Hi, thanks. Quite interesting. I had a couple of points. So one thing you said was, at least in Europe, I guess in Credit Suisse was very similar at the end, but anyway, 81 don't work as actually 81, which is something a bit worrying in a sense. I mean, I'm not sure about how much issuance there are, I mean, in the regulatory capital of banks, but still 81 are used for the numerator of the leverage ratio. So if they actually issue 81 and they're not actual 81, I mean, they shouldn't actually be there. And so we have this tier 1 common equity, additional tier 1, which actually probably doesn't work. And the second point was about, you said, I think at the very end, which was resolution authority or any kind of authority, I don't know, should have the power to actually trigger those instruments early on. But I think that's exactly what the Single Resolution Board already has. I mean, no, because there is this other, I mean, there is Carl Philipp, I don't know, he knows better than I do, the BRRD. But I think it's 59 or something, which basically says they can actually bail in within or outside of resolution. So they don't actually need to get into resolution. Whether they have done anything about that or are actually thinking of doing anything about that, I don't know. But also because it's a requirement from Basel on this point of non-viability. That's the way which Basel was actually transposing the European Union. It might not working, I don't know, but it's there in the rule book.
Can you give the microphone to my dear colleague, Professor Moore? Here, Claudia in the front. And then we collect it, and then for you to respond the two questions. Yeah, thank you.
Thank you. May you hear me? Thank you. When I heard your presentation and in particular the proposal to establish to some extent an obligatory trigger force for the authority to intervene. You mentioned also the Perotti proposal. I would like to better understand, but probably my doubt is this. This discussion recall me a very old discussion, the prompt corrective action after the saving and loans crisis, where many American scholars proposed that was obligatory to issue bonds, and that this, when there were in the markets some signals regarding the yields of these bonds, supervisory authority should have been forced to intervene. This proposal was never introduced so far. I guess because it's very difficult to understand in a correct way, in a very early way, moment, as you suggest, the signals coming from the market. So probably introducing an obligation to intervene at a very early stage it creates me some doubts, and my proposal will be in favor of more discretion to the authority rather than, although you are right, the two cases you mentioned, especially the US and the Swiss case, were clearly a failure of supervisory authority, and so probably the two things are interlinked. Thank you.
Okay, thanks for this. So first, just to clarify, I think I probably was not clear enough. So I did not say 81 does not work. I say COCOs don't work like 81 should. So there are other instruments that are perfectly loss absorbing in going concern scenarios. But you're right. I fully agree. These COCOs are, accepted by regulatory standards as 81, but we know from experience, empirical evidence that is really robust tells us they're not. Okay, and therefore, for all other sorts of calculations, these should indeed be removed. And then regarding the authority to write down and convert all sorts of debt instruments, you're right. This is in the regulatory framework, in the BRD, and also in the SRM regulation, but it only kicks in at the point of non-viability, and that is really, really late. And the idea is, of course, to come in earlier, and that also goes to Conchetta's question. So I think what Enrico and his co-author and I have in mind essentially is that, we do all these stress tests and we come up with a capital shortfall there. And what happens then is what I described, then you try to induce the bank essentially to raise capital. And that is something that is difficult. And therefore, if you have instruments in place of whatever, characterization that you can convert at that stage, and, for God's sake, if people don't understand that a write-off can occur prior to touching upon equity, then forget about any instrument that just gets written down. Always convert, fine, because then it's only dilution, and it's something that people probably understand better. But in any case, you have to have, and that, sort of speaks also to the US experience, of course, this stuff has to be in place prior to anything happening, because that's just part of your capital structure. You have this bail-inable capital, call it Emerald, call it Coco, call it whatever, and then you can trigger it. And you're saying, so authorities need discretion. Yes, probably yes, but this, and that's important. This is not a measure of cleaning up after it hit the fan. That is something that buys time in order to actually take action. And therefore, I, to a certain degree, agree with the idea of having a discretionary trigger, because it's a signal. If you actually trigger that, then of course you cannot engage in supervisory forbearance anymore, because that is obvious that you have to do something, and you only bought time, right? So you sort of adjusted the capital structure of the bank. It's more viable now, but there is still the problem. So if you have an unsustainable business model, like many of the regional banks in the United States probably had, you have all these other problems that occurred at Credit Suisse, you have to take action in this regard. And I think that's the basic idea, right? To buy time. But of course, understanding that regulatory discretion also makes this whole thing really litigious, right? So people will litigate, which we see happening. So I think that's my answer to this. Thank you.
Thank you very much. I propose that we close the discussion here. I think we have heard a good exchange of thoughts on this particular point. So As far as I'm concerned, we switch now to the topic of Gonzalo Gasós of the European Banking Federation on the capital floor implementation in Europe. Can you give the switcher to Gonzalo?
Thank you, Bart. You asked me to cover the topic of capital floors and internal models, which are very much linked to each other. It's a very, very extensive topic, and I will try to condense some views in just 5 minutes, telling some facts and some elements and fundamentals about internal models in banking. And then I will explain what has been agreed by the legislators in December in Europe about the implementation of Basel III and therefore the capital floors. So there is now a debate about the use of internal models in banking, a public debate, because there was always a debate that began in the academia and also in the central banks and also with the participation of banks 25 years ago, when we moved from the Basel I to the Basel II framework. And I would like to reflect upon the fundamentals when the internal models were put in place. It all began with the Basel II standard that was discussed largely during 6 years in the same format, academia, central banks, and practitioners with a lot of data. Following the development of credit scoring systems in the 90s, there was a wealth of information that became available. So the idea of the Basel Committee was to make good use of that information. And it was condensed in that paper of the International Convergence of Capital Measurement and Capital Standards, in other words, Basel II, that saw the light in 2005. And I would like to highlight here one aspect of the many enshrined in that paper, which was that banks must incorporate all relevant material and available data, information, and methods. So with that spirit, the internal models were developed. Number two, I like also to highlight a decision that was taken and that I think has a lot of informational value. It was in Basel II, but it remains in Basel III and in Basel 3.1 or Basel IV, no matter how you call it, which was known as the Madrid Compromise, and it was in a meeting of the Basel Committee at the time when Jaime Caruana was the chair of the Basel Committee, so the meeting took place in Madrid. That's why it was known as, and then the decision was taken that there would be a divide between expected losses that would be covered with provisions because they can be expected and therefore they could be provisioned, and then unexpected losses that would be covered with capital. Then there was the stochastic model to decide the level of confidence to cover the volatility of the expected losses that was expressed in the form of unexpected capital, and that is the core of that Basel II framework, complemented with the second pillar. And the second pillar literally said that capital should not be regarded as a substitute for addressing fundamentally inadequate control or risk management processes. That was written in 2005, but as my co-panelists have reminded us, it has been very much at the core of the crisis that we have seen last year. So I would emphasize the importance of that second pillar in terms of supervision of governance and risk management and controls. Then we moved to 2010. In the meantime, there was a global financial crisis. Let me say here, and I forgot to say at the beginning, Bart, that my observations and opinions are only mine, not necessarily of the whole banking sector. And let me say this, 2007, Northern Rock, I was in the UK, I was implementing Basel II, and then Basel II was enacted from 1st January 2008 in Europe. So I would argue it wasn't linked to the upsurge of the crisis. Of course, banks could hold more capital, and that would be beneficial. But I would argue of the two elements that were addressed by Basel III, it was more the quality of capital that took banks unprepared when the crisis emerged in 2008, because about quantity of capital, there were still the capital floors for 3 years until 2011. So that quality of capital, let's remember, there was that Sydney meeting where the tier 2 and the tier 3 were defined, and the banks could hold great quantities of these hybrid types of capital that they proved not loss absorbent in the burst of the crisis. Then the lesson learned was the development of these COCO instruments that we can argue they could be used before or after resolution, but anyway, they are subject to very strict conditions. That were not the case those days. So then from there, we go to the implementation of Basel III, the original package. And in 2016, the committee announces that all large internationally active banks meet the Basel III minimum and core equity target capital requirements. And then there is a question about the problems inherent to the internal models, with a very clear observation with data that there was variability in the estimation of risk-weighted assets and therefore capital in the banks. This was addressed in Europe by the European Banking Authority in the first place, with a lot of dedication in a very scientific manner. There was a thorough examination of undue risk weights variability. And yes, and this EBA repair program significantly reduced or even eliminated that variability, the undue variability in the models, because there can be variability, of course, depending on the strategies of the bank and the wealth of information they have. But the undue variability was arguably much reduced by that exercise, complemented with the supervisory exercise, the targeted review of internal models, also known as TRIM, that check also the compliance with the European regulation, as a result of which there was an increase in capital to address the problems that were observed during that 4-year-long TRIM exercise. In the meantime, things were happening also at global level, and the compromise on the finalization of Basel III lasted longer than expected, and it was agreed at the end of 2017. And there came the capital floors we wanted to discuss about. Therefore, the capital floors were embedded in the Basel III finalization, and they have been transposed to Europe, meaning an important increase in the capital of banks. Then when we go to the European environment, the Commission made a proposal that is, as usual, accompanied by an impact assessment, and the decision was taken that the impact would be softened, and it has been there expressed in that graphic of the Commission. Instead of having a cliff effect with a great impact the day of entry into force, that was allocated throughout a phasing period of 5 or 6 years. From there, we have now the agreement that the legislators reached in December in Europe in a democratic process. Every jurisdiction has a way of implementing the international global standards. In the case of Europe, is through a democratic process with the Commission, the technical body, the Council representing member states, and of course the Parliament that has the last say to approve. And I wouldn't stop too much on these slides that will be made available to all the audience and also those online, and where I summarize the decisions that were taken for this phasing of the capital floors during the next 6 or 7 years in all asset classes virtually, unrated corporates, also derivatives with this alpha factor that the US also took the decision to set at 1, On low-risk residential mortgages, there is also transitional arrangement upon discretion of the member states and also subject to certain conditions. High-quality object finance is another asset class that has been faced in terms of capital floors as well. Securitization positions as well, specialized lending. The credit conversion factors, interestingly, is one of the elements that Basel 3.1 introduced. Finally, also equity exposures, securities financing transactions, and interestingly, it opened the possibility of a reversal to a standardized approach that was not granted by Basel II, but now in Basel III, some banks might consider whether they could abandon the models and come back to the standardized approach. That is an option in the regulation. I would end with some final thoughts. In the industry, there has been the perception that we could be, with this legislation, fixing a problem that was already solved by the European Banking Authority and the ECB, at least to a large extent, with these exercises. And yes, now there is a debate whether the model should continue or not. We have seen that the United States, in the proposal, there is a removal of models for regulatory purposes. In Europe, we are keeping them, and I think there are other options which could be the refinement and the recalibration of the models. I think, in my opinion, the models that we are using today, they are still reliant on a calibration that was done, as I mentioned before, during a span of 5 years before Basel II, meaning from 2000 to 2006. Of course, the data that has been produced afterwards has been included in the models. However, there could be an interesting possibility to develop and to recalibrate those models with 25 years of data that we have by many banks with 2 or 3 economic cycles in the middle. That could be interesting, and I would propose maybe in the European Banking Institute there could be an interesting research ahead of us. And I know in some universities they are running some PhD and research about these calibrations of the Basel formula and the Basel data. And my final thought is banking will evolve in whichever way in the next 20 years for the next generation. There are many possibilities, even radical ones. That maybe we could imagine a banking model or a lending model without leverage. Who knows? Who knows? But in that case, the only thing that would still have value would be the models, because lenders we will always have. Equity funds, banks, leverage, or whoever, we need to keep the value of the wealth of information that our models are giving today. I would end in that point.
Yeah. Thanks ever so much. And it is as... It is, as you say, basically we will make the very detailed sheets and the points that you conveyed available. I had one question, and then I suggest we end the panel with the introduction of Peter Mülbert. One question to you: what if you read basically discussions on capital floors? And obviously, the impact will be that in certain jurisdictions, particularly the northern jurisdictions, there will be a quite drastic increase in capital requirements because internal models were quite risk sensitive, and the floor basically takes that risk sensitivity a little bit away. Okay. That must result in more capital. That's being debated by the banks. That might not be a very good effect. That's obviously understandable because raising capital is difficult and depending on market circumstances. But what always catched my eye, and you introduced that also, discussing about the Madrid, the Madrid Accord, basically. Internal models is not only about quantitative capital requirements. The ECB is quite in favor of the use of internal models because of the beneficial effects on qualitative risk management. And are we not forgetting about that discussion? Because indeed the impact of the capital flow might be that banks might start reconsidering the use of it. Because they don't, from a capital management point of view, they don't make any sense anymore. But then you throw away also the beneficial effect of qualitative risk management. What's your view?
Yes, I would agree very much with what you say. I mean, at the end, the models give information, and that information is valuable. We experienced that in the crisis of the pandemic, where the supervisors needed immediately a lot of information that was readily available thanks to these developments, to take action in different directions depending on the needs of the moment. Now, you say, of course, the impact of introducing capital floors is asymmetric. It depends on the business model. And what is important is whenever we introduce a prudential framework, it happened 20 years ago, and it will happen again with this one. The market adjusts to that framework. Therefore, if a certain asset class or portfolio is more expensive in terms of capital, then there would be some sort of adjustment or a potential shift to other lenders. Now we talk a lot about a shift of lending to non-banking financial institutions. So we also have to be conscious. The question of the capital floor doesn't end the moment that you apply it, but it has implications, and we need to be aware of that. But as you mentioned, these fundamentals of the Basel II agreement are important, and one of them was the idea of business integration and the use test that I think it's now kind of forgotten. But at the end, what happens when a bank sits with the investors, they have a view of the riskiness of their portfolio that is agreed with investors and the analysts. And it's now, with the capital floors, it is separated too much from the regulatory requirements. So there is a conversation with two models. One is the regulatory one that you need to have for good reason, and the other one is the assessment about the risk of your portfolios that you can portray to your investors and analysts and convince them about it. And that is what I think is happening in the banks that are mostly hit, as you mentioned, of course, banks that have it happened to be, I mean, it's not only a matter of geography. You have very low risk portfolios in southern countries as well. It's not, but they are, of course, more concentrated in certain northern countries, yes.
Right. I think we should leave it by this. And thank you again for the introduction and the brief discussion of the question I had. I propose that we go to the final panel list and for the introduction on changes CRD 6, governance, fit and proper testing. Peter, the floor is yours.
Thank you, Bart. Since I'm standing between you and lunch, I will try to be as brief as possible. I have only to talk about basically 4 or 5 articles that have been added in CRD 6. Now, why did the European Commission intend to add new articles? According to the explanatory memorandum, to further harmonize supervisory powers and tools, and in particular, the fit and proper framework is one of the least harmonized recognized under EU banking supervisory law, which makes life particularly difficult for the ECB, since according to Article 4.3 of the SSM, it has to apply national laws. And given that there are 21 different national laws to observe, life is maybe a bit more difficult than the ECB would like it to be. Now, how does the Commission intends to make the fit and proper framework more harmonized? It replaced Article 91, the previous CRD4 version, by a new version, which basically is more readable and has hardly any new additions. Then it introduces the Article 91A, the suitability assessment by the entities themselves. And since it's in bold, it's an important new add-on, Article 91B, the suitability assessment by the supervisor, 91C, the suitability criteria of key function holders, and what is also new, 91D, suitability assessment of the heads of the internal control function and the chief of financial officer, and the suitability assessment by the supervisor. So it's basically the suitability assessment by the supervisor, which is new to CRD6. And what is new is building on in substance on two papers, the joint ESMA and EBI guidelines from 21 and the ECB guide to fit and proper assessments also from 2021. Both are 76 pages long, and I will not be able to give details in my presentation. Well, the management board, what is the management board? The supervisors are supposed to assess. The management board is both the management board in its management function and its supervisory function. That is to say, the proposal is built on a monastic board system. Article 91, as I explained before, is more organized, more structured than before. And it has one important add-on, namely that the management board has to possess collective knowledge, skills, etc., also to take into account the environmental, social, and governance factors, which is a result of the ECG movement. But the interesting thing is that it's the requirement is one for the management board as a whole, but obviously you need to have some people on the management board with expertise in that area. So there are implications for individual board members, but the implications are not clear. Now, Article 91B, the suitability assessment by the supervisor, one of the core new elements, it applies to certain important large institutions, and it provides for a pre-clearance procedure for all board members. That is to say, for the members of the management board and its management function, as well as for the management board members in the supervisory function. There's an 80-day assessment period, which can be extended by 40 days at most. The assessment is not on occasion of the mandate renewal, but the board members, if they do not fulfill the requirements at all times, post-clearance is possible in exceptional situations. And, well, one of the problems that were raised is what about supervisory board members that are elected? Because if they have, if there's a pre-clearance before the elected supervisory board members will be able to take up their position, well, that could be 3 months. And so how do you pre-clear supervisory board members since elections have a tendency to be not, or the results might be not known beforehand. So you would have to pre-clear also those that are not elected. In addition, well, if members of the supervisory board, now talking about the German situations, are not allowed to act as such for some period of time, you will imbalance the board, especially in given the co-determination, German style for large institutions. Would that mean that you will have to rely on staggered boards? Just a question. Now, the supervisory powers in case of non-fulfillment are 3 members to be part of the management board, remove members from the management body, and requires entities to, I call it, educate the members accordingly. Now, one of the important, the interesting powers would be to remove members from the management board. Now you may question what that means, namely to remove them from the board function, or also to terminate any contract between the institution and the board member, to terminate for cause. I think that would be a solution preferred by the banks, because on the impact of remuneration, not to be paid anymore. Now the power is also enshrined in Article 16.2m of the SSM, and I'm wondering about the interplay between that power and the power provided for by Article 91b for national supervisors. Key function holders, that are persons who have significant influence over the direction of this institution below the board, and they include in particular the head of the internal control function and the chief financial officer. They are also subject now to suitability. They will be subject to suitability requirements with respect to both their personality and their capabilities. These requirements are basically the same as for board members, and were detailed before by the ESMA EBA guidelines. Now, the head of the internal control functions, and I think this application of the requirements for board members to the persons, to the key function holders, is a bit problematic. On the one hand, you are overstretching the requirements because they are not board members and they do not have to operate in a board of environment. On the other hand, you expect them to be more knowledgeable in with respect to their specific functions they fulfill, and to have more extensive knowledge, at least from my point of view. Finally, for the certain important institutions, again, that there's a clear clearance procedure, the same as those, the supervisory powers are the same as those regarding board members. That is to say, you can remove them not from the board, but remove them from their function. And that implies, to my understanding, that you will be able to terminate the contract for cause. Otherwise, they would still be working at the institution. Well, sorry, I forgot to fast forward. And now, what are the conclusions? Well, one of the conclusions is a very obvious one. the power of the supervisors will be enhanced with respect to persons. And that implies, in particular, the pre-clearance, the introduction of the clear-clearance procedure, that long-term strategic personal planning is becoming ever more important, not only at the lower levels, but also at the board, in particular at the board level, which might be an interesting task for executive searchers. I was not able to talk, sorry, Bart, but let me finish by saying that I was not able to talk about cultural differences regarding pre-clearance. The ECB already introduced pre-clearance, and there's a very well-known case, at least in Frankfurt, regarding some German bank. I think that banks will still have to get used to more or less degree throughout the EU to that concept. Thank you.
Thank you very much, Peter. In its nature, the example of the suitability testing of key function holders, which is indeed the issues that you put on the table are evident. On the other hand, this is one of the few examples where banking law follows insurance law, because for insurance businesses we already have this system of testing the B and the C levels on suitability, particularly. But that leads me a little bit to a question. Have you got the impression that any changes that are now basically put on the table in the provisions that you just mentioned, you already referred to the wish of the ECB basically to have a little bit more uniform law in that respect, but do you have the impression that experiences in other member states basically have contributed to the design basically of the new rules, and that the effectiveness of the new rules basically might then follow a little bit the path of the way it has worked in some member states?
Well, only indirectly, because as I mentioned then the beginning, these provisions are basically modeled on the expectation or on the guidelines formulated by the ESMA and EBI on the one hand, and the ECB guidelines or assessment procedures, those of 2021. So in that sense, they are the result of experiences from supervisors from some from EU member states, but they were these experiences were in a way collected and by the ESMA EBI guidelines, and therefore this is I think the collective outcome of the experience.
Thank you. What we should not forget basically is the ECB, of course, has been setting a quite important line there, but the ECB is looking at the Eurozone countries, and we have also had the EU is larger than the Eurozone. So that's one of the things. Tobias, you had a question.
Just quickly, I know this has been a pet project for many years, but the question that I want to raise is, does it make a difference? Now we have harmonized rules on fit and proper testing, which we also have in the United States. So the Federal Reserve and the FDIC are testing fit and proper according to uniform rules. And what happened is, SVB, well, you know, these people. And the thing is, this is nice, you know, you get good input if this works, you get good people, but according to paper by Oliver Hart, Luigi Zingales, what dominates once they are appointed is, of course, their compensation contract. And as long as the compensation is drawn up in a certain way, you can have super fit and proper people who just will not do the right thing. And I don't know. So the question is that a placebo or is that meaningful?
Peter?
Well, the interesting thing about, I think, in that respect is that the CRD4 provisions, as amended in 2019 regarding compensation, were not, did not change. So compensation, that might tell you that, at least from the perspective of the Commission and the ECB and the EBA, compensation schemes in Europe worked quite well after the financial crisis, it's too difficult. It's even more difficult than maybe COCOs to design appropriate remuneration schemes. Simply do not know.
Thanks. And as regards remuneration, there are quite some differences, notwithstanding the efforts to harmonize that. So, but I think your topic has been very well introduced. We have had a bit of a discussion on that. I'm grateful for that work. We've reached a little bit the time that the organization has given us for this panel. So please join me in applauding the contributions of the panel and the discussion. And with this, we can go to lunch.